Subscribe to our YouTube channel and press the bell icon to get the latest updates.
Hello friends, I'm Vijay Bhambwani. I trade these markets since 1986 and I hope my videos are helping you decipher the nuances of these markets better. As a teenager, I used to go to my dad's office in Mumbai's famous Zaveri Bazaar, the bullion market. And I remember in 1980, I was going to my dad's office with my dad and I heard a lot of commotion outside some shops. They happened to be wholesale silver shops. Those were the hurly-burly days of Hunt brothers rigging up the price of silver, taking it to stratospheric levels and briefly touching $50 a troy ounce in the US markets. And once their multi-level leverage exposure started unwinding, silver fell down a whopping 85% or more. Does this happen very often in commodity markets? Is this an isolated incident? Do we see anything like this every couple of years? And how you can basically safeguard yourself against such an event occurring? You see, very recently, now you are actually a witness to history in the making. Very recently, the Russian army invaded Ukraine and expectedly so, commodity markets got the jitters and everything from gold, silver to oil, natural gas and base metal prices started going up. But one particular metal was even more noteworthy as compared to the others for the simple reason that it tripled, that's right, tripled, and then collapsed 60% from its peak, all within a span of 4 weeks. I'm talking of nickel, a metal that has bankrupted tens of thousands of traders worldwide in a stratospheric parabolic rally which started from 23rd of February. The price of nickel on the MCX, as you can see on the chart, was close to 1,850 rupees per kilo, went all the way up to 5,600 rupees plus, collapsed to almost 2,000 rupee mark, all within a month. Now this is the kind of bone-crunching volatility or statistical beta which can bankrupt a trader, which is exactly what happened. Now let's go back in time. Like I told you, in 1980, you had the Hunt brothers silver pump and dump, for the want of a better word. In 1985, tin also witnessed a similar cornering by some big-time operators and a short squeeze occurred. Prices went through the roof and trading in tin was banned for all of 4 long years. Nickel was briefly banned by the London Metals Exchange, and it's only now that some semblance of normalcy is returning very slowly, albeit very, very slowly. But the margins are so high that I'm seeing volumes of 10, 15, 20 or 50 lots per day. Now that we've seen tin, do remember in 2005 what happened to copper. In those days, I used to be a guest columnist for a newspaper called Business Standard. And one fine day, I got a call from a Chinese, an overseas expatriate fund manager stationed in China. And he said, Vijay, I want you to cover a story. We've basically gone long in copper in China, but we are unable to book profits because the exchange is saying we have no long positions. It was later found that a rogue Chinese trader had gone short on copper and the metal, of course, shot through the roof, which means anybody who was short had to pay top dollar to square up those shorts, which is precisely what has happened in nickel. A Chinese entrepreneur known in the markets as the Big Short held huge short positions in nickel through a company called Tsingshan Holding Group Company. Now, the problem is up to 8th of March, he kept on paying his mark-to-market losses. But beyond the point, when a commodity goes from 100 to 300, and it's a very, very leveraged market, your margin could be anything from 3% to 8%, which means you could be leveraged anything from 35% to 35 times to 12 times. Paying mark-to-market margin on such a counter becomes a humongous task. It's very, very difficult for a trader to hold on to his position when the margins are A, doubled or tripled, and B, the span margin goes to 10, 12 or 14 times of what he had paid. So when mark-to-market margins rose through the roof, then system-based orders came in and they started buying, because once a breakout above a certain price occurs, algo traders start to push prices higher. Those are called systems orders. Now, when system orders started pushing prices higher, there was no recourse for anyone, including traders in the Indian Commodity Exchange, the MCX. There was no recourse other than to cover. That led to a spike up and an inverted hammer on the chart that you saw earlier. And after seeing 5,600, I saw the price of 2003, 2004 rupees on my screen, all within a matter of a few trading sessions. Is this the last time that this is happening in the commodity markets? I don't think so. Will it happen again? Yes, it will. 2005 China, 1985 tin, 1980 silver, 2022 nickel, 2020 crude oil prices, which went below zero very, very briefly for a session or two, but it did break the back of many, many long position holders. Is this an isolated incident? Not really. Will it happen again? Yes, it might, and I think yes, it will. What is the ideal thing to do in a scenario like this? Number one, when volatility goes through the roof, the only recourse and the most sensible recourse that is to cut back on your exposure. That way, statistical beta or pure price volatility will not hurt you as it would hurt a guy holding 2 or 3 times more exposure than you are. Number two, do not try to fight the trend, the existing price trend. Whenever a parabolic rally like this occurs, and that too with sharp rise in volumes, it should be understood that large price moves like these with heavy volumes means a whole lot of money is propelling the price higher, and it does not actually make sense to stand in front of a speeding train and go against the flow. And thirdly, it would be a very, very expensive error to think it has gone up too much. A lot of traders I know shorted nickel saying it has gone up too much. You know, the trader is nobody to make that decision of whether the counter has gone up or gone down too much. You have to go with the weight of evidence. You have to do a lot of chart reading. In my many earlier videos, I've discussed the snap quote window, wherein there are 5 top buyers and 5 top sellers, and how you can decipher many trading signals from the snap quote window. So as long as the snap quote window is telling you that you should be exiting a position and squaring up your long or your short position, don't drag on. And the fourth point, if after you enter a trade, if you have to start praying and hoping that your trade becomes profitable again because it's losing money now, something is wrong. Because hope is even more addictive than opium. I actually call it hopium. So if you have to resort to hopium to come out of a trade, it means you've done something wrong, and the faster you come out of that trade, the better it is. I can think of no simpler and more effective solution to a problem that might occur once every couple of years. And it takes place cyclically in one asset or the other. Tomorrow it could be some particular stock. Day after tomorrow it could be a currency. Or it could be a particular individual country's market that could be taken significantly higher or lower based on some news data. This is a standard operating procedure that I have. Cut back on exposure, take a stop loss, watch the snap quote window and see whether the signals are telling me to hang on or to exit. And if the trade is telling you to exit, do not smoke the hopium pipe. That's one of the most expensive errors to make in any asset class, in any market at any given point in time. On this cautionary note, I'll bid goodbye to you, not before reminding you to click like on this video if you liked my advice here. Subscribe to my YouTube channel if you haven't already done so. In the comment section, do let me know what you feel about my work and what I can do to solve your investment queries by way of fresh new videos. Also, help me reach out to fellow like-minded investors and traders by referring my videos to your family and friends. And I thank you for your patience for being with me in my video till we meet again in my next. This is Vijay Bhambwani signing off for now. Take care. Bye-bye.